If you've been at Microsoft for 10 years, you've been accumulating shares the whole time through RSUs or the share purchase plan, if you've left them in your Fidelity account, you very well have a six-figure tax bill looming when you decide to use that.
Welcome to Tech Money Smarts with Novel Wealth. Before we get started, it's important to remember that the information provided in this video is for educational and informational purposes only. It's important to seek independent professional advice from qualified financial advisors before making any decisions about your finances. I did want to actually ask you a very specific question that kind of speaks to some of the needs of the clients that you guys work with. And this is the idea that you're working for a tech firm here in Canada, but now you've been promoted or you're going to have to move to the US. And here's the question. If that happens to you, should you still be contributing to your company's RRSP, or should you be using some other form or different accounts?
Yeah, there's lots to unpack when you're talking about anything cross-border. That's an area I spend a lot of time in. You know, like so many things in financial planning, the answer is it depends. But typically speaking, like California is a weird exception. California doesn't recognize RRSPs. You actually got to pay tax on the growth in your RRSP, and it creates that dreaded double taxation situation that everybody's looking to avoid. By and large, unless you fall into a weird case, the US actually does recognize RRSPs. And so contributing them while you remain in Canada actually is part of a good long-term strategy.
All right, okay. Anything to add on that, Sham?
Just if you know that it's imminent that you might be making that move, you might want to consider investing in a non-registered basis outside of that RSP. There's a really good chance you'll need to liquidate those accounts and fund your new lifestyle overseas.
Yeah. And you know, when you're talking about moving to the US, one thing that comes up a lot is TFSAs. Phenomenal tool for Canadians to avoid paying tax on long-term growth. As soon as you move to the US, they become a no-no pretty quickly. So the IRS doesn't recognize a TFSA, meaning while Canada sits there and says no tax owing, all that growth can go, the US is going to tax you on that growth all the way. And so you might look at it and say, geez, I don't mind paying a bit of tax in the US, I'm going to keep my TFSA. But that's only half the problem. What a lot of people don't realize until they're down there, there is no tax slips prepared for TFSAs. There doesn't need to be in Canada. And so you get to filing your first US tax return, and it's an absolute nightmare trying to gather all the information you need.
Wow. Well, I guess before we wrap it up today, gents, I want to touch on one more nightmare, and that is around RSUs and what happens when they vest. Who would like to take that?
RSUs, when they vest, that amount is treated as ordinary income.
Okay.
This is the number one complaint or frustration that our tech professional clients have. It's why are they getting taxed so heavily? There's really nothing that they can do about that tax withheld at source. So for most of you, 50% or a little bit more of those RSUs are lost to tax right away. Our big complaint, which Jerome can expand on, is tech professionals are not doing anything with their shares after they vest and they get into that Morgan Stanley or Fidelity account. Right. Tremendous opportunities, but time and time again, we're seeing these brilliant individuals not take advantage of it.
Yeah, we've had clients that have accumulated so much of their company shares, Microsoft, Google, Amazon, whichever company it may be, and they're really proud of building that nest egg, right? They got skin in the game, they're invested in their company, and it's a really good feeling for them.
And also those shares have just rocketed in value.
Yep.
Right?
Yeah, for people that have been there a long time, I mean, and that's the good part, but it's part of the problem as well, Brian. So if you've been at Microsoft for 10 years, you've been accumulating shares the whole time through RSUs or the share purchase plan, if you've left them in your Fidelity account, you very well have a six-figure tax bill looming when you decide to use that, whether that's retirement, buying a cottage, putting your kids through school, whatever it may be, you've got 6 figures of tax. The travesty of it all is for a lot of people that could have been avoided. There's places, it seems like it's forbidden fruit and it has to be left there untouched until its final purpose is met, but that's not the case. You can move them, you can put them into registered accounts. There's a lot of things you can do to shelter them from tax, and so it's heartbreaking when you meet somebody where that ship has sailed and that tax bill is already looming. But even in that situation, when you have the capabilities we do, there are things you can do. There's Section 85 rollovers. There's a way you can defer tax and solve the problem of having that big looming bill and a bunch of shares in one company sitting in the wrong place.
And that's a great place to end, because it brings us full circle to the beginning of the conversation when we said, you know, if you are a high income person and you're making some good money now is the time to start talking to a wealth advisor, because they're going to prevent you from encountering those problems down the road, right? You don't need to wait until you have a huge bank account to get proper advice. Now's the time to do it.
No, and frankly, you shouldn't. A lot of the cases I was just referring to are people who waited too long, and it wasn't until they had this big, enormous problem that they finally had the impetus to reach out and kind of get some advice. So you hit the nail on the head, Brian. I would say anybody with ambition, anybody with income and kind of a growing pool of wealth that they're trying to manage. It's something I know well. I mean, there's a lot of complexity that comes along with buying a home, with starting a family, with all the different life goals that you kind of hit along the way. But I would encourage people honestly to do two things. I mean, seek advice, but one thing we didn't touch on, which I think is a really important message, don't just focus on investments. And I see this time and time again. I see people talking about returns. I see people focusing on their portfolio. And of course that's important. People want to earn a good return on the money they've saved. But it's the tax planning, it's the strategy, and it's having a plan that you're actually following that I encourage people to really reach out and get some good information on.
Thanks, Jerome. Thanks, Sham. Well, we covered RSUs, tax cliffs, and all sorts of other things today. And if you feel a headache coming on, well, that's a sign that you've outgrown your current strategy. So subscribe to the channel, or even better, stop procrastinating and book a free call using the link below. This has been Tech Money Smarts with Novel Wealth, and we'll see you next time.